All right, welcome back everyone. Let's get ready for the next topics, which you can see on the screen. The topics that we are going to cover, it is not just involved with the current session, but it will occupy for most of the remaining classes from now to the end of the semester. And what I have mentioned on the earlier class, this is the areas which it is guaranteed in every single sittings there will be a questions that come on this area. And the marks that are related to this particular part of the topic, it will be about 20 marks minimum. And these are the areas which is possible to appear in either section A, the case study, or section B as a standalone questions. As I said to you, those of you who have learned finance in paper F9 or in the degree, these are usually one of the areas which many students are always get very worried and very concerned about. But as I said to you, once you manage to get the concept right, and then you have to just go through a bit more of the practice, you should be fine to deal with these kinds of the questions. Okay, my advice for you, among many of the syllabus area, this is in fact one of the areas that is easiest for you to score very well. That's provided you put in enough effort to do a lot of practices based upon the discussion and advices given to you during the lecture. Okay, let me just start off with the overview on what is price risk management all about, which relate to the next 4 chapters which you can see on the screen over here. If you recall to the first day of the class, in the overview of the syllabus for advanced financial management, as we have highlighted, this is a subject that is all about managing money for businesses. That obviously cover the way that we raise the funding and how do we make use of the money that we have raised for picking and selecting investment. But when we make decision on funding and investment, usually we have to look forwards by relying on predicted information or forecast information to derive the basis of our recommendation. But we also know the information that is arriving from the future is never guaranteed to be correct. So it is always be expecting information that we derive from the forecast was subject to error. And way back in chapter 2, we have been talking about techniques that allows us to take into account of risk and uncertainty, if you remember, and if you can recap some of the technical instruments that we have covered, such as expected value, simulation model, including some of the new techniques that you have learned in chapter 2, such as value at risk, etc. Those are the techniques that allows you to quantify risk and uncertainty. But what we are going to cover here, it is the tools for managing. So we're not here to quantify, but we are here to learn how to manage the risk and uncertainty that arise in making the decision. Okay, and you can see the title. The risk that we are managing is only confined to price over here. And having said so, I just need to remind you, in fact, beside AFM, there was another papers that you should have also covered risk management quite well, and that is your SBL. But the syllabus of risk management in SBL is much broader. Only thing is that it is not as deep, it is not as technical as comparing to AFM. So, coming to this particular area in AFM, we are not covering broadly to all kinds of risk management, but we only zoom in and focus in the way to manage the price risk. So, at the first place, everyone, let's take a look at the overview by understanding what do we mean by price risk. Well, as I mentioned to you, risk, it is all about referring to the uncertainty arising from the future information, which particularly relevant to all decisions that we are to make. So price risk, it's all about volatility in prices of a specific assets in the future. That is what we call price risk. The keywords that you can find from this explanation tells us what is actually risk. Risk refers to volatility, or we can refer this as the fluctuation. What is the volatility we're talking about here? It is the prices, it is the value of an item. At this moment, let's refer this as specific assets. And not only that, the last things that you have to keep in mind, this volatility in prices is arising in the future period. And that is exactly what I said to you. When we make decision, we will never know what will happen in the future. That is why we have to make a prediction. And because things may change, and your prediction is therefore subject to error, and that relates to risk. Okay, so price risk is therefore referring to the fluctuation in the prices of something in the future. Now, before we learn how do we manage the price risk, which is one of the key elements in financial management, if you take a look at this statement, the first things that we have to clarify is, Mr. Chan, when you say price risk is about the volatility in prices of a specific asset, what kinds of asset are we referring to? Yeah, there's a good questions over here. Now, of course, if you refer to the market, there are many items that people are buying and selling in every part of the world. Okay, and every items that people are trading at, there must be a price. And how much is the price of these items to be traded in the future? Nobody knows. So therefore, price risk appear, and price risk arises in almost every single item for trade in the market. But for exam purpose, especially for this exam paper, we scale down the ranges of items that we are looking at to only 3 types of items. And therefore, we are having only 3 types of specific assets. What are they? Firstly, we have a specific asset that is called foreign currency. That is the first asset we're looking at, foreign currency. The second type of assets that we are looking at in the syllabus, it's money. The third and the final ones that we have in the syllabus of AFM, shares, ordinary shares in particular for a company. Well, of course, there are many other types of items in trade. There are many other types of assets in trade. But as I said to you just now, we only focus on the 3 of these asset types over here. Okay. Now, the next things that you have to know is, Mr. Chan, what is the meaning of foreign currency? What's the meaning of money? What's the meaning of share? That's the first thing. Secondly, in order for you to understand the volatility in the prices, you have to first know, what do you call for the price for the following assets? What is the name of the price for these 3 items of asset over here? So only you know the name of the price, then only you start talking about the volatility in the price. Then only we talk about the way to manage the volatility in this pricing. Okay, so let's start with the first questions that we have raised just now. What is the meaning of foreign currency? Too bad on the video I can't show you the physical money, but I can draw up something on the screen over here. Okay, now imagine you are in Malaysia, so that's where you are right now. Okay, when I show you these 2 pieces of paper, one, it is a ringgit, the other US dollar. In Malaysia, when someone show you 2 pieces of currency notes, one is ringgit, the other is US dollar, then I ask you, which one of it is a foreign currency? Well, I think everyone will be able to tell their answers correctly. If you are in Malaysia, the foreign currency refers to the US dollar. Okay? If US dollar, it's a foreign currency. What do you call for ringgit Malaysia then? Ringgit Malaysia is called home currency. Home currency. Okay? Now, imagine, I'm not going to amend or rectify any words that I wrote on the screen now. Okay? What if I say you are now in USA? Which one of it? It's a foreign currency. If you are in the USA, obviously ringgit Malaysia is a foreign currency and US dollar is a home currency. Agree? What if I gave you the third example? If you are in the UK, if you are now in UK, which one of the two is a foreign currency? And your answer would be both are foreign currency. See? So hopefully from these examples, that give you some idea what exactly is foreign currency. It is a currency that is not in use in the country where you are at. That is called foreign currency. Okay? Now, do you believe and do you agree if I say, no matter where are you in Malaysia, UK, USA? Well, it doesn't really matter where you are. When we trade of an item, meaning when you are buying, when you are selling something, every item for trade must come with a value, must come with a price. Agree? Example, if you want to buy oranges in the market, what do you call? For the value of orange, we say price of an orange. If you want to buy a car at a car showroom, so what do you call for the value of the car? We say, what's the price of the car? Okay, so this is what we call the price of the item for trade. Questions. In Malaysia, what is the price of this item for trade, which is US dollar? What is the price of the US dollar for trade in Malaysia? The answer, the price of this piece of foreign currency, it's called, we don't call the price of US dollar, obviously, it sounds very weird, but we call this as foreign exchange rate. The price of the foreign currency is called foreign exchange rate. From now on, instead of using the word foreign exchange rate, I will just use the word forex. Okay, I'm sure you must have heard of the word forex quite often. It stands for foreign exchange. That's what we call forex in short. Okay, so when you hear people say, what's the forex for US dollar? That means what is the price of the US dollar? Okay, now knowing the name of the price for the foreign currency, now I move on to the next items of assets. Money. Now, I think a lot of us, when you come to this item, you say, Mr. Chan, I get confused already. I thought foreign currency and money is somehow related, or some of us even say they are all the same. Okay, let me answer these questions, okay? Now, going back to these two pictures that I draw just now on the screen, we know which one is home currency, we know which one is foreign currency, okay? Again, if you are in Malaysia, and we're looking at the same currency notes, ringgit, US dollar, same question asked to everyone. Which one is money? Which one of it is money? Of course, you cannot say money is US dollar. Wrong answer. And then Malaysia ringgit is not money. Wrong. Okay. Money in this case refers to both. Both ringgit Malaysia and US dollar. Both are money. Questions for everyone. Has money got a price? Has money got a price? Yes, of course, money has a price for it. What is the price of the money called as? Price of a foreign currency is called foreign exchange rate. Price of the money of every country's currency is expressed by something called interest rate. Okay? Interest rate is always seen as the price of the money. If you don't know what I'm talking about, not to worry, because when we come to this chapter later on, we will learn this more in detail. Okay, let's continue, yeah? The third items of asset that we have to cover in the syllabus is shares of a company, particularly ordinary shares of the company. Well, I don't have to say much. What do you call for the price or the value of the share? That's simply called as share price. Okay, so we saw the name of the price for the three assets. Of course, I will leave the rest of the items aside because these are the only three things that we are looking at for exam preparation. Okay, now imagine the three prices that we have highlighted just now: forex rate, interest rate, share prices. I want to ask everyone a question. Do you think these rates, or do you think this price, from time to time, it remains stagnant, or from time to time, it keeps changing? Forex rate, take for example, if you go to the money changer today, you look for the foreign exchange rate for US dollar, assuming the rate quoted at 4.3 ringgit. That's today, yeah? What do you expect this rate will be tomorrow? 4.3 or different from 4.3? Most likely, it will be different from 4.3. Yes? Same thing apply. If you go to bank, you check up the interest rates for our deposit or for our borrowing rate. The bank tells you 3 months fixed deposit rate currently is at 2.9%, let's say. Would it be the same for a month later or 2 months later? If you go back to the same bank and checking, hey, what is the interest rate for the 2 months deposit? Will you expect still the same at 2.9? May not be the same anymore. So this tells you all these prices changes at all point of time. Agree? The changes, the fluctuation on all these prices is called volatility in the price, which to a business viewpoint, all this volatility in the prices is giving rise to unknown. If somebody asks, who is running a business, hey, exchange rate of US dollar today is 4.3 ringgit. How about tomorrow? I think nobody can answer. So we don't know what is the exchange rate for US dollars going to be. So to these businesses, this is the price risk that we're talking about. And what price risk is this? The price risk on foreign exchange. Same thing apply for interest rate and same thing apply for share price. Okay, so from all these price risks that we are having, when the prices are uncertain, it gives rise to risk, as I mentioned to you. Okay, so all these prices are therefore giving rise to 3 types of price risks. And what do you call for these 3 price risks over here? We will be discussing all these price risks in more detail. For foreign exchange, we are going to cover in chapter 7 and 8. For interest rate, we are going to cover in chapter 7 and 9. For share price, we will cover in chapter 7 and 10. So, we will have a more in-depth discussion about price risk on the 3 items of assets in the respective chapters that you see in the screens right now. Okay, so that basically gives you a very brief explanations on which are the 3 areas of the price risk that we are looking at. Okay, let's get started off. After the overview of learning what is the meaning of price risk, I am going to touch on management, on the 3 types of risks that we have highlighted just now. 1, referring to chapter 7 and 8, we are managing the risk arising from fluctuation in the forex. What is that called? Forex risk. Forex risk. It's a risk arising from the uncertainty in the forex rate. Okay, and then of course the other thing that we will cover is in chapter 7 and 9, as I mentioned to you, what risks are we dealing with? The name of the price is called interest rate, so we are touching on interest rate risk. And finally, we have unit 7 and 10 that will cover the management on share price risk. Management on share price risk. So these are the 3 types of risks that we have highlighted casually, and I am listing down 2 here. Management on the 3 category of the risk. Now, before I go into detail for each and every one of it, okay, I just want to highlight to you, from now until the end of the semester, we have about 11 classes left behind. So let me just tell you this, okay? Out of that, we need to spend about like 3 classes or to 4 classes to cover the first category of risk management. And then we have to spend about another 3 to 4 classes to cover the second category of risk management. We will spend at the most 2 lectures on the third category of risk management. When Mr. Chan looking at the number of classes that we allocate, clearly the first 2 areas are the most important one. That is absolutely true. Okay, so that basically tells you the number of classes that we left behind, how do we manage to cover the 3 categories of risk management. Okay, before I move on into Forex risk management for you today, let me just give you some of the overview, what exactly the exam questions would like to test about management on this above risk. Usually, when the questions is testing on this, the first area, which is what we're going to touch on in a short while, what gives rise to the volatility? What causes the fluctuations on these prices? So that is what we call causes of the risk. Okay, let's refer this as item 1. One of the key areas that you have to know. What gives rise to the risks? That means what make the foreign exchange rate fluctuate, what make the interest rate fluctuate, what make the share price fluctuate. Secondly, make sure you must be able to discuss, you must be able to talk about the impact. In other words, the effect of the risk on the company. Well, if you look at your exam questions, every single questions were based upon a company. And on this topic, the questions were always led to us. The company is having this and this business transaction. And then they will tell you, but there will be a kind of price which is remain unknown. So the unknown or the uncertainty in the price is giving rise to price risk. And therefore, the questions may ask you, briefly discuss, briefly evaluate the impact or the effect of such risk on the company. As I mentioned to you in chapter 5 earlier, when you see the word effect, okay, always focus on off something, on something, and your focus of answer is based on what, because you have to tell me how does the risk affect the company in different aspects. Okay, in short, this discussion is very much related to understand how the risk affect the company. We have to later touch upon the types of risk, or you can say the types of exposure. Okay, different types of risk will affect the company in different manner. So you need to go in deeper to differentiate what types of risks that we're dealing with and how each and every types of risk affect the company. And that will therefore be the second area we will be discussing in deep. And here comes the third area, which is the key of this chapters in the syllabus and the lecture. Okay, now you know how the risks affect the company. Now it is the questions of approaches as well as strategy used for risk management. Approaches and strategy used for risk management. For different type of risks, how do we manage them? What is the good, what is the bad about the way that we manage the risk in this manner? As you must remember, okay, nothing is perfect. No matter what approach, no matter what strategy that we are using, each and every approach, each and every strategy has a good and also has a bad point. Okay, so at the end, which approach and strategy will you recommend? You need to evaluate. You need to weigh between the benefit versus the cost. Only the approach or the strategy where the benefit outweigh the cost the most will be recommended. Remember. So this is the area that will require a very tedious technical evaluation to find out what is good and bad on each and every technique, and how does this technique affect the company at the end. So from the calculation, then you have to draw your recommendation and advices. Okay, so these are the three key areas that we will be discussing on the especially forex risk and interest rate risk. Okay, for the time being, I would like everyone to keep the focus on the first two types of risk management. Okay, I will touch on share price risk in the separate note and the separate way, because the exam questions or the syllabus of AFM is testing on share price risk in a very different way comparing to the first two. So again, I would like everyone to keep an eye and stay focused on the first two categories of risk management in answering the three key questions that we have just raised. Well, that will be the overview on the types of price risk managements that we have to cover based upon the introductions of price risk just now. Let's start off with chapter 7 and 8. Therefore, that will be the in-depth discussion looking at the first category of risk management, foreign exchange risk. Get ready, everyone. Forex risk management. Forex risk management.